All right, let's get right into it. Today we're doing more than just looking at a stock chart. We're going to deconstruct a professional trade from start to finish. And we're using Oracle as our case study to walk through the disciplined process that a real analyst uses to evaluate a major company. Let's begin.
So here's the big question on everyone's mind. Oracle has been on an absolute tear. And that brings up the classic dilemma, right? After a huge run-up like this, is there any juice left to squeeze? Or did we miss the boat? How do we decide if it's time to jump in or if it's time to just wait? Well, that's exactly what we're here to figure out.
To answer a question that big, you can't just guess. You need a process. So we're going to follow the exact 5-step framework an analyst would use. First, we'll get the story behind the stock's rise. Then, we'll dig into the hard numbers, the earnings. After that, we'll look at valuation. What are we paying for this growth? Then, the critical part, timing. And finally, we'll put it all together into a solid action plan.
Okay, let's start with the narrative. What's the big story here? Why has Oracle been doing so well? It really comes down to a fundamental shift in their business.
Look, the market has woken up to the fact that Oracle isn't your dad's database company anymore. Their big pivot into cloud infrastructure, what they call OCI, and their deep dive into AI has completely changed the game for them. This isn't just a minor tweak, it's a structural shift that has caused the market to completely re-rate the company, valuing it way higher than it used to.
Now, a great story is fantastic, but you know what they say, show me the money. It has to be backed up by real financial performance. So let's move from the story to the hard numbers and see if this cloud and AI push is actually making them any money.
And wow, take a look at this. This chart shows Oracle's earnings per share over the last 12 months, and it tells the whole story. Just look at that clear, powerful step up starting in 2024. This proves it's not just hype, it is real, tangible earnings growth, confirming that their strategy is absolutely hitting the bottom line.
But, context is everything. What's really interesting here is how Oracle stacks up against the competition. Oracle, that's the blue line. It's crushing the broader S&P 500, which is the red line. No question about it. But you can see it has, at times, struggled to keep up with the breakneck pace of the wider tech sector, in green. So the takeaway? Oracle is a very solid growth company, for sure, but it might not be the fastest horse in this particular tech race.
So, we've confirmed this story is real, and the earnings growth is there. The next logical question for any of us is, okay, what's the price tag? What are we actually being asked to pay for that growth? Let's talk valuation.
This price-to-earnings chart, it tells such a fascinating story about how the market sees this company. For years, Oracle was a classic value stock, trading between 15 and 20 times earnings. But then, as that cloud and AI story really took hold, you see this dramatic expansion. The market is now willing to pay over 30 times earnings for it. It's being treated like a true high-growth tech leader. This is that re-rating we talked about right here in living color.
So, is 30+ times earnings too much? Well, this gives us some perspective. Oracle's PE, again in blue, is definitely expensive compared to the overall S&P 500 in red. But notice how it's tracking pretty closely with the average for the tech sector, in green. So what's the bottom line here? You're not getting a bargain, not by a long shot, but the price isn't totally irrational when you compare it to its direct AI-driven peers.
Okay, so let's recap. We have a great company with strong growth, trading at let's call it a fair, if high price. But this, right here, is where professional discipline really kicks in. Because a great company isn't always a great buy right now. Timing is absolutely critical.
So, to help us get our timing right, we're going to use a specific tool called the momentum cascade. Don't let the name scare you. All it is a way of looking at a stock's trend across different time frames, short, medium, and long term. By comparing them, we get a really clear picture of the health and the strength of the stock's move. Okay, now let's actually use it. In a perfect world, in a super strong uptrend, what we call a bullish cascade, you want to see the short-term momentum, that's the blue line, just consistently surfing on top of the other two lines. But look what's been happening lately. That blue line has gotten choppy, and it's dipped below the others. Now, this doesn't mean the long-term story is broken, but it is a flashing yellow light. It's a clear signal of short-term weakness telling us the stock is probably consolidating. It's telling us to be patient.
But it's not just about one chart. A disciplined strategy uses a checklist. So let's run through it for Oracle right now. First up, the Zacks rank. This system grades stocks based on what analysts are doing with their earnings estimates. Right now, it's a #3 hold. We're looking for a #1 strong buy or a #2 buy, so that's a fail. How about volume? Volume is strong, plenty of interest. That's a pass. Insider buying? Nope. We're seeing executives selling shares, not buying them. That's another fail. And as we just saw in the last slide, momentum is mixed. Long-term is good, short-term is weak. The system is crystal clear. The key signals for a low-risk buy are just not lined up right now.
So, we've gone through the story, the earnings, the valuation, and the timing. Now it's time to bring it all home and create a clear, decisive plan of action.
So, our final verdict, based on all of this evidence, is a hold. Or, put another way, watch. Now, it's so important to understand what this means. This is not a sell call. Oracle is still a high-quality company. This is a call for strategic patience. The conditions for a low-risk entry point, they simply are not met today.
So what do we do? Here's the explicit plan. Step 1 is simple. Put Oracle on your watch list. Step 2, define your triggers. We are going to wait patiently for that Zacks rank to get back to at least a #2 buy and for that 4-week momentum line to turn positive again. And step 3, keep an eye on the valuation. If the PE ratio dips a bit, that gives us a much better margin of safety. We don't act on hope, we execute when our criteria are met. Period.
And that, right there, is the essence of professional investing. Having a great idea about a company is just the beginning. The real edge, the thing that separates the pros from the amateurs, is the discipline to wait for the right price and the right time. The process is what gives you that edge. So I'll leave you with this question to think about. What signals are you waiting for?